Hey everyone, welcome back to another episode of Nadlan Forum Podcast Daily. I'm Lior, and if you caught last week's episode, we tackled reverse mortgages for seniors. A pretty dense topic with a lot of risks and, well, I guess, misconceptions. But today, we're shifting gears, zooming in on something that's got the whole financial world buzzing again. The Fed's rate cut dilemma. I mean, if you're like me and you're watching the headlines, you probably saw all this talk about another 25 basis point cut being all but a done deal for the FOMC, right? Markets have basically priced this in. I think it was over 95% on the CME Fed watch, so the surprise level is honestly pretty low. And here's the real kicker. Policymakers are flying a bit blind right now because the ongoing government shutdown left them with almost no official data to work with. No payrolls, no proper retail sales numbers, just crickets. So you've got these Fed folks relying on things like private data, some market inflation signals, even alternative trackers. It's a bit like trying to land a plane in the fog with just your GPS and not much else, if that makes sense. Now, within the FOMC, there's actually some drama brewing. Some members are really cautious, saying, look, we need actual proof that inflation's on the way down before we do anything dramatic. Others, they're just like, nope, let's move now, because waiting could make things worse if the economy suddenly stalls. And honestly, both sides have a point. This is one of those moments where, as we've discussed before on this podcast, back when we covered market volatility and mortgage rates, central banks kinda have to wrestle between action and patience when their data is fuzzy. So it begs the question, should the Fed go bold based on sketchy data, or do you play it safe and risk being behind the curve? Personally, I always lean a bit toward caution. But, I mean, maybe that's just my Israeli upbringing and too many years in New York real estate. But seriously, no official FOMC meeting in November means the October decision is like twice as important. It's the main signal for the next couple of months. Also, real quick, a wrinkle to the story, consumer spending. Some of the economists are saying, hey, the top 20% are still spending, but the rest, their spending's barely tracking inflation. So, if you look only at headline numbers, you risk missing what's really going on under the hood. All right. Let's bridge that into what you probably care most about: mortgages and home buying. So, as the Fed's been shifting toward these rate cuts, we're already seeing it play out in the housing finance world. 30-year fixed mortgage rates, they dipped below 6.1% last week, actually scraped down to 6.04% according to Zillow and those Florida realtors guys. Now, that might not sound like much because just a year ago we were staring at 7.32% across the board. But that drop can seriously change the math for millions of borrowers. Let me give you a concrete example. One of my clients, let's call him Dan, not his real name, but Dan's always refinancing every time there's a pulse in rates, right? He bought his place in mid-2024 when rates were brutal, locked in at 7.32%. With these new lows, we're looking at a refi at 6%. That's about $290 less every month on a $300,000 loan. And you stick with that for 30 years, you're talking nearly $67,000 in savings. And that's even after you factor in all the annoying closing costs. Not bad. There's always a but in real estate. Lower rates don't automatically make houses more affordable. Inventory is still scrunched. Prices, let's just say they're stubbornly high. So what ends up happening? People rush to jump on those lower rates. But with so few homes to go around, you get bidding wars again, and boom, prices get sticky or even shoot up in certain zip codes. I mean, I had folks last month asking me if easing from the Fed actually helps or just fuels more competition. Back in episode 5, when we talked about the golden handcuffs and how low rates can freeze inventory, this is exactly what I meant. It's not just about rates, it's about supply. So yeah, if you already own or you bought in that spike last year, now might be the first real window to refi and get some relief. But if you're buying, it's still a seller's market out there, and rates are only one piece of the puzzle. Shifting a bit, but not too far, let's talk about the Fed's other big lever, the balance sheet. Chair Powell has started hinting that the Fed might hit pause on this quantitative tightening thing they've been running. Basically, they'd stop shrinking their stash of treasuries and might actually go back to reinvesting in them. Got a little technical there, sorry. But what you need to know is if the Fed stops letting those bonds roll off and keeps buying, that pushes down long-term rates even more. And since mortgage rates are basically glued to the 10-year treasury, it means even cheaper home loans if this goes through. Of course, it's a balancing act. Inflation, it's down, but not out, still hovering around 3%. The Fed wants to avoid loosening so much that they light a fire under prices again. But at the same time, nobody wants to be the reason we tip into recession. It's a risk management game now, not a let's juice the economy one. I always get clients asking, Lior, is now the time to buy, sell, refinance, go all cash, or just wait it out? And look, with both rate cuts and possible balance sheet support coming, you can see outsized effects on mortgage rates, way beyond just a quarter point here or there. That double impact could actually tilt the market. So let's wrap it up with some food for thought. In this kind of uncertain, maybe double easing world, how should you be positioning your real estate investments? Should you lock in low rates while you can? Or do you wait for more clarity on inflation and the Fed's next moves? Hit me up if you want a direct consult or mortgage review. Nadlan Capital Group is here for that. And if you're a regular, you know we never stop at just today's news. Keep tuning in, we'll break down the next moves together. Stay sharp, everyone.